Hello everyone, today is April 1st and this is session number 13 of the Wyckoff Trading course. We have this session and then two more sessions left and that's it, and we're going to be done with the whole course. So one of the things, and I'll talk about this a little bit later, I want you to start thinking and sending me some of the questions that you might have for session number 15. And that session is going to be on any type of questions that you have. Now, you gotta send me a question with the chart, because we've done this many times in this class, and what students usually do is they say like, okay, for this and this stock, this is the selling climax, this is this, and so on and so forth, and we can't see it. We can't really see what you mean when you write it, because there could be so many interpretations. So you have to show me a question on the chart. So start sending those, and I'm going to start accumulating those. All of the questions now are going to go into the question bucket, so I'm not going to be answering those during the classes. And then this is when we're going to address those. I've also seen that you guys started registering for the practicum, so that's great. I'll see you there. After our first session is going to be on the 22nd, also Monday. Yeah, and it starts on the 22nd, I think, or the 29th. I'll have to double check. And as usual, everybody's going to be invited to that first session of the practicum. We're going to do an exercise together. I'm going to give you an assignment. So if you have any questions about the practicum, let me know, email me, and we'll just go from there. Okay, so what are we going to cover today and in the next session? So today we're going to actually, we're done with the group exercise. We're going to talk about comparative and relative analysis. And this is going to be the case study on Home Depot. So we're going to go through that. We're going to establish the base of knowledge on relative and comparative analysis. A lot of the things, as I mentioned, are going to look somewhat similar to what you're already doing, or maybe you heard about. There's not a lot of magic to the outperformance or underperformance, but there are some nuances that are extremely important. Plus, we need to connect everything to into the structural analysis as well. I'm gonna have to look at the homework and remind myself, did I do this correctly or not? Okay, and then the next class, we're going to continue with the comparative and relative analysis. We maybe even jump ahead a little bit and talk about the Wyckoff trading plan. Just going to depend on, how quickly we're going to move here. Okay. Guys, what was the homework? I just feel like, I put the lecture material first. So what was the homework for today? Were we supposed just to watch the recordings, right? Yeah. Okay, great. Okay. Yeah, so now I kind of know. Okay, we're just gonna go through the case study first and then we'll deal with that. Okay, so let's talk about relative and comparative strength analysis. The first chart that I have here for you, this is the chart of Home Depot monthly chart and Spiders, the ETF for S&P 500, also monthly chart. And we're seeing the history here from 95 to about 2015. And the first thought, the first concept about the comparative analysis is going to be a Wyckoff concept, where he stated that he wants to compare significant lows to significant lows and significant highs to significant highs, and then compare to instruments like a stock and a market proxy, and say that at some point at this significant high, the stock is stronger, and at this significant low, this, let's say the market is stronger. And to see that relationship of strength at those significant highs and lows. Why is this important? Well, because if we're thinking about a significant outperformance, let's say that the market is going down, right? Like we have had the market going down in 2008, 2009. And as we're looking at the low in the stock, and then we're looking at the low in the market, we're seeing that the market probably had more underperformance around the low. And actually on the way down, we see how the price travels down so fast. We don't see this in the stock that much. There is a very quick recovery back into the close, and so on and so forth. So when we see this discrepancy with which the price moves in the stock and the market, then we start thinking of the reasons why this discrepancy would be. Why would the stock not move as much to the downside? Well, obviously, if it's not moving as much, it means two things. Either there is less selling and the stock is not being sold as much as the market, or alternatively, there could be some demand that's coming in and that absorbs the supply and either stops the downtrend, or it just produces the downtrend that is not that aggressive. So moves maybe with less aggression. So moves down less. Moves down less. And then when we look at the picture of how the price of the stock moves, and we see that it moves less, there is less selling. We see some elements of the demand, let's say on those type of bars where the price recovers really quick. We would be saying that those are all the elements of institutional buying. And we just seen this institutional buying or institutional accumulation in this case through comparative strength. And we could see that somebody's buying here, somebody of institutional quality, and they're probably going to hold on to the stock for some time if they're buying at this, institutionally. Not only that, now if we're thinking that institutions are going to buy and then hold, this means that supply is not going to be available. Supply not available. And if supply not available, then we are going to be in some kind of uptrend environment, and we could potentially, if supply is not available, and then imagine that the news from the company that is coming out within the next, let's say, couple of years, 3 years, within the next business cycle, and we look at how the price moves. And this is not even done, right? We had a move in Home Depot even after 2014-15. So they're going to hold on to this stock for quite some time based on their business cycle expectations, based on how the news about the revenue for this company is going to come. So not only it's going to be an uptrend, it also could be an outperformer. Again, let me just go through the logic of why in the future it could outperform. We're seeing how the market moves down very rapidly in 2008. We don't see the same aggression in the price moving down in Home Depot in 2008. Instead, we're seeing a downtrend, but we see a lot of recoveries. We see a lot of attempts to stop the price from moving further down. This means that somebody is stepping in and starting to buy this low. And that's what produces this stopping action. And if the price even moves to the downside, it still has a lot of buying behind it. And we see this in the tail here, or multiple tails at this low. If institutions are buying, they are absorbing the supply, and that supply is no longer available in the market, because we know how big CO type of institutions, they hoard their supply for the business cycle. They usually, kind of like put it in the vault, and just go away for years and years. So that means that the supply is not going to be available, and as with the improvement of revenue flow, other institutions might be inclined to go and buy the stock, and that's going to produce more of an auction situation, where with the auction, the price will be pushed up, the price will be marked up. So it's crucial for us to identify these spots where the stock starts misbehaving than the market. It just tells us the story of what's going on at this particular spot. Is there buying or is there selling by institutions? Okay, so that's the whole logic, that's the whole idea. So what was Wyckoff looking at? He said to measure this, the outperformance by the stock against the market, we have to compare significant highs, synchronize them, and then look at the next significant high. And look at the slope for the stock and look for the slope for the market. And see if comparatively the price makes the same come back to the same high. And here in this case, we're seeing that Home Depot did not come back to the same high. The market has, right? So from significant high number 1 to significant high number 2, the stock has not. It actually created a significant lower high. So what does it tell us? It tells us that somewhere here in this area, we're clearly seeing that as the market goes up and as other stocks are being bought in and marked up, Home Depot was not of interest to institutions whatsoever. If anything, after a certain period of time, they started slowly giving up on their shares. So therefore, in this area, we are going to say that the stock was underperforming the market. And if the stock is underperforming the market, then there is no interest, at least currently, from institutions to participate in the stock. And that means that most likely, whatever the moves are going to be to the upside or to the downside, they're probably going to be not significant, and most likely will be, will fail. And that's the whole idea. We want to understand if institutions are in the stock, if they are buyers or sellers. And this should give us a perspective as to the future performance of the stock. And obviously the idea is just we want to be in the stocks that are going to be outperformance, significant outperformance. I call them sometimes super leaders. Those are the stocks that are going to multiply so many times, and they're going to be in the supply in that stock is going to be in very, very strong hands. All right, so we looked at the significant highs. Now let's look at the significant lows, right? So what would we do? We would synchronize the lows first. So I would take this low right here in the market. I would look at what bar on the stock this low is, and then I would do the same with the next low. So here's the next significant low for the market. I would look at where the low in the stock is, and then I would do this trade and try to compare again and compare the strides. And it's very clear to me that in the case of significant highs, where we have a lower high for Home Depot and we have kind of like a flat high for the market, this lower high suggests that the stock is weaker at this point. Please note that even though it's weaker, we don't know exactly what would be the behavior of institutions at the next low. We just know that being weaker suggests that we might see some kind of outperformance to the downside. And initially, right here, we were underperforming. When the market was still creating the new highs, look at how Home Depot already was going down. So I tell my students that outperformance or leadership is causal as well. Not just the price, and the price swings are causal to the creation of the uptrend. We also could look at the leadership causality and incorporate that into the law of cause and effect. The more causality we see of comparative relative outperformance in this area, the more we're thinking that institutions are extremely aggressive at these lows, and they are extremely aggressive with their buying. So therefore, we could project that the effect of this initial leadership in the trading range could resolve itself in the significant leadership that would follow afterwards. And that's the whole idea. So let's look at the low here. So significant low, the slope for the stock, the slope for the market. And I would say that still that the market is weaker here just because of the slope. The stock is stronger. And then on the lows, on the highs, we had weaker stock, stronger market. And we would go through points like this, and we would identify in the trading range all of those points of strength and weakness. And we would try to create the logic behind of how the strength and the weakness starts to occur. And then we also will be looking at the relative strength analysis. This is a modern or relatively modern tool in identification of the performance. All right, well, let's look at that. So in this case study, we're going to look at different spots in the trading range. We had a very, very big uptrend on the monthly chart for Home Depot. Then we had a significant change of character. And please note that even on the monthly charts, you could see how the change of character produces the trading range relative to the distance of that change of character. It's a significant change of character. It's not the change of character that we had here, or let's say here. It's twice as large, maybe even 3 or 4 times as large. So that suggests that the duration of the trading range is going to increase. So anything that we are looking at here is very questionable. And obviously what we want to see is we want to see some kind of outperformance here that would suggest that institutions are getting into this position. And as they get in, they absorb the supply, and that would mean, a good sustainability of the trend. Yet it doesn't happen this way. And we're going to look into the daily chart right here. Then we're going to look into this area, and then this area, and this area right here. And you will see how the leadership characteristics are actually starting to change. So let's look first into the range of 2002, 2003. All right, so let's do this. Let's have a volunteer, so just say yes, and I'll unmute you, and we're going to go through all of these points, and we'll talk about what is stronger or what is weaker at all of those points, the market or the stock. All right, volunteer? Anyone? All right, let's do it. Adam. How you doing, Adam?
I'm doing good, Roman. How about yourself?
Yeah, I'm okay. All
Great.
right, let's look at point number 2. So let me repeat this first before we go somewhere else. So when we look at the high, we want to compare that high with the previous significant high. Where would you think that where is that significant previous high?
For SPY or Home Depot, which one?
Either. You kind of
Uh,
have to probably look at both.
I mean, the previous significant high looks like, prior to April there.
Yeah, somewhere here, right?
Yeah. Yep.
Everything else here is just of the same quality, of the same magnitude. So we would be looking at something like this for the market. We would be looking to synchronize this high with Home Depot, and we would be looking at a Home Depot like this. A little bit hard for us to make a judgment as to, um, you know, the slope. Because think also about the scales, right? Sometimes we would not look at the ETFs. We would look at maybe like the Dow Industrial, and that index is in the thousands. So it's going to be hard for us to reconcile the scale. But we'll talk about the another tool that we could use. If we can't really, um, on the comparative basis, uh, make a judgment as to what is stronger, what is weaker, we could always use a relative strength ratio line. And a relative strength ratio line is just basically, it's a price-based tool based on the price um, of the stock over the market proxy. And you could change this. You could have a stock here and you could have a sector and measure the strength of the stock against the sector. You could have the stock here and measure it against the strength of the group that the stock belongs to. And it's always going to give us some kind of line, um, and that would be our relative strength ratio line. And one of the things that we could do here to help us out is, as we synchronize the high, it's actually right here. Sorry about that. So it's here. Let me just erase this. So here it is on the relative strength. Here it is on Home Depot. And then we want to take the measurement of relative strength. If it is hard for us to see that slope, then we could identify on the relative strength these two spots. Just basically see, did the relative strength deteriorate or not? And we see that it did. So we're gonna say that the stock relative to the market at point number 2 is weaker. And we could see this also from the relative strength ratio line, the way how the line unfolds. It's this blue line. The two other lines, the brown and black, those are moving averages. Why are we using moving averages here? Well, because moving averages are trend following tools, and basically price divided by price is not necessarily creating the price, but it's based on the price. So you're going to apply um, the same tools as we would use, the same trending tools or oscillating tools that we would use in our price trend analysis. So therefore, if we would look at this line, the blue line, the relative strength ratio line, and we would give that line a definition of the trend, what would we be saying here? We're seeing lower highs and lower lows. And that's a definition of a downtrend. So we know that the relative strength is deteriorating. So institutions are preferring to have other stocks in their portfolio more than Home Depot on the way down. And that's what it means. Okay, well, we kind of like took probably, a more difficult one. Adam, let's look at number 3 here. What do you
Sure.
think is stronger at point number 3, the stock or the market?
Well, um, just for that little gap, it looks like, just based on the relative strength, the blue line, Home Depot is showing outperformance there since it's moving up, but Home Depot's still on a downtrend. So if I were looking at that relative strength chart, I'd probably still stay away from Home Depot and, own SPY. But the blue line is moving up, right? So for a very small window of time at point number 3, Home Depot is slightly outperforming relative to SPY, but it's underperforming in the context and the construct of a downtrend. So, I would still stay away from it.
Okay. So what
But
if we don't look at this?
okay,
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 on the comparative basis, let's start with the comparative analysis. Let's start with something that required a visual identification of strength, something that Wyckoff himself did back then. Even in his original course, you guys could find two charts, one under another, and it would be the chart of the stock and the market or the group or the sector, and that's exactly how he would look at this. He would do it exactly this way. So at point number 3, looking just at two price data points for the stock and the market, Adam, what is stronger, what is weaker? At point number 3, not before, not after, just at point number 3.
um,
And obviously relative to what, right? Because we always would say comparative analysis. So this means being compared to something else. So point 3, we're comparing to what?
well, if you're just comparing the lows, right? I mean, they're both at a low exactly at roughly the same time.
Yeah.
Um, but SPY is at a double bottom equal to where it was. It looks like they're on the first of whatever month that was.
At point number
Whereas,
1,
yeah,
right?
point number 1, yeah,
Yeah.
yeah. Whereas Home Depot is obviously, lower. It exceeded its previous bottom. So, one relative to the other, the SPY is going to be stronger.
Here we go. And that's all that we want to see.
Okay.
That's the whole skill that we're developing right here. Identifying significant lows for both instruments, synchronizing those, and just saying we want to see a progress of performance that was made between these two significant lows.
Gotcha. Okay.
And Adam is absolutely correct. In the case of the market, in the case of the spiders, we have a double bottom. It's a flat line right here. And then compared to the stock, we're seeing that the stock is actually making a lower low instead of being flat. If the stock would behave the same way as the market, the stock price would stop somewhere here. And that would be a comparative parity, with the market. But instead, the stock is creating lower low. Now, why? Why would the stock create lower low? Well, there is probably a little bit more selling in the stock than in the market in general at this point of time. So we would say that the stock is weaker and then the market is stronger at this point. So, and again, as Adam started, his analysis, he said, I see that the stock is weaker. I probably would not be interested going into the stock. So, in other words, if I would translate that statement, it just basically tells us, I see that the stock is weaker. So therefore, institutions are not extremely interested in the stock, and the timing is not now for the price to leave, And the timing of this selection might also not be that great.
Right.
So we want to stay away. And look what happens next. If we would be thinking about the next rally, the market is outperforming on the next rally. It has one move up, second attempt, third attempt. The stock has one move up, and then the second attempt creates lower high, and the next attempt creates lower high again, and then it starts to underperform into 5. So you could see how the identification of weakness here in this area suggested that there might be some weakness staying forward and that this stock is going to be underperforming the market potentially. So would we want to be in a stock like this on the upside? No. There are some other stocks that are outperforming the market at point number 3. Those stocks could have lower highs, suggesting that whatever selling here happened, it was not significant and the supply has been observed. So therefore, the next move is going to be much more favorable. Well, if we are not sure, again, if we're not sure that at point number 3 we have stock underperforming, look at the relative strength ratio line. We still would compare it to the low at point number 1, and then we would look at the low at point number 3 and look at what happens here. There is a slope to the downside. So relative strength ratio line deteriorated, suggesting a weakness in the stock relative to the market. So we could use a comparative analysis that Wyckoff used back there, 100 years ago, or we could use something more modern, like a relative strength ratio line that I believe was created in the 40s, 50s, and that is a very much institutional tool. Institutions create a lot of systems based on relative strength performance. And they put this relative strength on stocks, on groups, on sectors, and the money goes, and their systems are based in a lot of cases on this relative outperformance during a specific period of time. Those institutions are institutional trend followers. They are trying to systematize their point of entry based on the emergence of the trend, and not on the price trend, but also on the relative trend as well. All right, Adam, let's finish up all of these points that we have here, all those numbers. Let point number 4, what is stronger, what is weaker?
SPY is stronger. Yeah.
Okay, and again, really quickly, look at the slope.
Yeah.
And look at the slope of the stock. So we see that the market is stronger, almost coming back to the highs of point number 2. All right, point number 5.
Good question. So, it looks like if you were to draw a line there, the slopes would be similar, but you can just use the relative strength ratio and just look at that from, A to B, and you can see that it looks like, SPY is still stronger.
Yes, SPY is stronger.
Not by a lot, but it's stronger. Yeah.
Okay.
Yeah.
Well, again, what are the 2 techniques that we're using here? Visual technique, comparative analysis. So from this previous significant low to the current significant low.
Yes, very good. Yep, absolutely.
Yeah. So look at the slope. Look at the slope. So the market is definitely showing a much more significant slope than the stock.
I'm drawing a line from 4 to 5. Sorry. So
I
anyway,
see.
you're good. You're good.
Yeah,
You're good.
okay.
Yeah, no, your line's much easier to tell, Justin.
Okay, all right. So, and then the same here, 3 on the relative strength line, and then 5 on the relative strength line. And again, the slope is down. So the stock is still underperforming. Okay, well, let's not forget about this now, Adam. So let's look at point number 6.
Yeah, it still looks like, just looking at from 5 to 6, it looks like the SPY line is more shallow than the line from 5 to 6 on Home Depot. So,
Yep. So we're seeing that the stock is still weaker here at 6. If
yeah,
you want a confirmation again, look at the relative strength ratio line and compare these 2 points and look at the progression of the price ratio line either up or down, and compare significant low to significant low both on the stock and the market proxy. Okay, so it's interesting picture where we're seeing that there is a lot of strength in the market in this area, and then the stock is just basically weaker, 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 weaker. So if the stock is weaker, Adam, what do you think institutions are doing here? Are they in this position? Are they aggressively buying?
well, they're it just looking, since it's a daily chart. I mean, I'm not seeing any candlesticks that would give me an indication that they're buying. But
But
I mean, you have some.
think about just the comparative analysis that we've done in this area right here in this box, right? So what does this comparative analysis suggest the institutions are doing? Are they buyers or
The,
sellers
the,
or what
it
do
would
you think?
appear they're sellers.
Yeah, they either not buyers, right? So
Yeah,
if they don't buy, what is the stock gonna do? Most likely
it's
it's gonna kind of drift and then go down
yeah, it's in weak hands.
because if we don't have the support by from institutions, and they don't buy, most likely the stock is going to be in the downtrend. So we kind of see that the market is much flatter at this point, but there
Mhm.
is no interest from big institutions, on this stock. So therefore, let me ask you this question. Does it mean that this is an accumulation or a distribution?
Great question.
Tricky question, very tricky question.
Well, since we can see without knowing anything going forward, is that how you're asking me the question? But I mean, just looking at the chart, you could be potentially in both. I mean, even the inflection that I mean, obviously from 6 to 7, Home Depot is starting to show strength finally. So now you're starting to see a shift there, but
But how would we be thinking about this idea, accumulation or distribution? At point number 6, are we in the accumulation or are we in the distribution?
at point 6, I mean, at this point, the stock is being sold off slowly, so it's a distribution phase. But we should be thinking in terms of accumulation at some point. I'm just trying to think through it myself, Roman. I'm not really sure. I mean, I guess
And don't
if
forget, I said this is a tricky question. So the answer is probably going to be on both sides, like you said.
yeah, yeah, I would come back and follow your techniques, right? I mean, I would go back to point number 1. I would be drawing lines. I would be saying, all right, where's my selling climax?
Mhm.
Where's my automatic reaction? Where's phase B? Where's potentially phase C?
Okay.
Is
So
point
Adam,
number, yeah.
you want to complicate our lives a little bit? So let's do this. Selling climax, automatic reaction, secondary test, phase A, test and B, and here we are potentially in phase C. Is this an accumulation or a distribution? Point number 6.
Okay, so I got to say accumulation.
Okay, so let's just say that this is an accumulation, and we're thinking that this is an accumulation. Is this a good accumulation for us to participate in?
No,
Why?
it's it's not very defined. Um, to me, when I look at this, it doesn't look very defined. It seems too slow. The progression seems very slow. Um, and I look at phase C and I don't know. It doesn't look very defined to me. I wouldn't have in other words, I wouldn't have a comfort level. I don't see,
Okay.
a shakeout. I don't see a spring. I mean, I'm not really seeing that unless I'm missing something. But
Well, obviously we know that this was an accumulation. It probably would be really hard to define that at point number 6. Why? Well, because of the whole weakness that we're seeing in this range.
Right.
Because the weaker range is going to suggest that institutions are not doing anything, not active.
Yeah.
And therefore, if they are not active, then they are not accumulating. Well, how would the price then go up if they are not accumulating? Well, in some instances, that accumulation will start a little bit later. So let's say somewhere here,
Mm-hmm.
this is where we're going to locally see institutional buying.
Yeah.
And that would suggest, when we would go through all of these points, 6, 7, 8, 9, and 10, or rather 7, 8, 9, and 10, we're going to see that the market is actually drifting down, and then
Yeah.
the stock is starting to show some strength here. So we're seeing strength
Yeah.
that basically suggests how would the strength be showing on the price? Well, somebody's buying, and that moves the price up. And if we're seeing this, we know that the strength is going to be associated with institutional buying. So they started buying between, let's say, 6 and 10.
Mm-hmm.
Okay, so listen to this, guys. What I'm going to say next is going to be important because you could define your visual pattern recognition on the relative and comparative strength just based on this concept. Leadership is causal, not just the price. We know this law number 3, right, that we were taught about law number 3, cause and effect. What does it say? It says measure the cause and then define the effect by it. Now think about in terms of this same concept of cause and effect and how cause defines the effect, but at the same time think about this cause and effect relationship on the relative strength. So what we're seeing here is the major part of this trading range is actually weaker than the market. So if I would be thinking about the long-term picture, Adam, or long-term performance, what would be my conclusion as to the potential long-term performance of this stock after we've seen such a weak trading range to develop?
Well, it would just seem to me if it's been weak for so long, that when you did start to finally see, Home Depot compared to SPY start to show outperformance and show strength again, that's probably, the pendulum is going to shift the other way, and this is probably going to, end up being a leadership stock, and they've either figured something out with their company to get things on the right track. So anyway, I would be thinking of like a campaign position or a
This
long-term
this
position.
this could happen this way, but we are trying to define the relationship between causality and the effect. And we are saying that leadership is causal. So therefore, if we would take this whole trading range and we're going to maybe divide it into 2 portions. Let me just do this. Let me redraw this. So 2 portions to this trading range. Long-term picture, weakness. Short-term picture, outperformance or strength. So if this is the cause for long term and this is the cause for short term, then what should happen next with the leadership? And this is all causality, right? So if this is the cause, then what should happen on the effect side of things? With
Price should go. Hopefully prices will go up.
Yes, but I'm asking you what's going to happen with the performance. So, but
Oh,
think, Adam, hold on a second. I'm kind of seeing where you are. So just kind of like follow my logic here. We
sure.
are talking about causality, and we are defining the causality of the leadership in this trading range. And we're seeing that the long-term picture or the long-term cause that is being shown to us is weakness. There is no strength there. And we said that institutions are not actively buying in this whole trading range. Now then look at 6 and 10. That causality is very small, but it shows out performance. So therefore, if we are saying that performance is causal and the effect is going to be in the equal outperformance or underperformance by what is being shown to us in the trading range, then what should we have on the next move up? And the price will move up. We see it. But how is it going to move up? Is the price going to, is the stock going to start outperforming? And if it's going to outperform, is it going to outperform? How is it going to perform short term and how is it going to perform long term? Think
Well,
about cause for the long term. If it's weakness, then the effect is going to be the same, right?
hmm,
So
okay.
if the long-term picture for this trading range suggests that institutions are not buying, then the long-term performance is probably going to be underperforming, right? So the long-term effect is going to be underperformance.
I'm tracking with you. Yeah.
But then the short term right here in this area from 6 to 10, we said that the stock is stronger at 7, stronger at 8, stronger at 9, stronger at 10. Suddenly there is so much strength. Why? Somebody is coming in and somebody is supporting the stock, and then other stocks are not really having that type of the performance. So that suggests short-term buying, which is going to lead to the short-term uptrend, and it's going to also lead to a short-term outperformance. And that's going to be the short-term effect.
Okay.
In other words, think about like big institutions and how they initiate the opposition, and they would be initiating throughout this whole trading range. But here, only this supply on at this point has been observed very quickly, and then that suggests short-term outperformance. Do we see a short-term outperformance here, Adam?
Yes. Yes. Yep.
How do we see that? Well, look at the relative strength line. It's just going up. It's above the moving averages, and it's creating higher highs and higher lows.
So what you're saying, Roman, is from like points 1 to 6, that July, August, September, October, November, you're saying that's the cause, and that span of time is what's going to result in long-term underperformance potentially of Home Depot compared to the market.
Yeah,
Is that what you're?
yeah.
Okay, okay,
Well,
okay.
law number three. Remember, guys, we kind of touched upon this a little bit, right? So law number three is going to say, when you have a trading range, that's your causality, and if you measure this causality, you could see that the effect is going to be equal to the same distance, measured distance, as your cause.
Okay.
And this is for the price, and we could use the PNF to define this relationship. Well, I'm saying that this relationship between causality and effect could be also qualitative, right? In terms of the performance. So we
Okay.
could say that let's say in the trading range, the relative performance causality is going to create some kind of outperformance as an effect.
Okay. I'm tracking with you now. I'm
Okay.
following you.
So then we could take this concept a little bit further, and we could say we are seeing that during the trading range, there was a lot of underperformance. this underperformance suggests that institutions were not buyers. So therefore, long term, we're probably seeing underperformance. And then short term, we're seeing that there was some buying, and that suggests just initial outperformance. And we see it right here in this trend. So if we were thinking about long-term and short-term trade, we probably would be thinking causality is very small here to outperform. So it's probably a swing trade instead of a long-term trade. For the long-term trade, we want to see either institutional accumulation in the trading range or very aggressive buying on the way out. So either or, and we don't see neither, right? So we don't see institutional accumulation from 1 to 6. And then whatever accumulation happens here, this is more short-term hands. So suggest a short-term outperformance. So a swing trade would be better at that point of time. Does that make sense, Adam?
It does.
Okay, well, if it doesn't, then let's look at the next example really quick, and then it will make a lot of sense. So now we're looking at 2008, 2009, and think about the same concepts. I don't want you guys to think about the relative strength as just a filter that's going to show that the stock is outperforming. I want you to understand why. And what is it exactly that we are looking at when we look at the relative strength? We just basically look at the relative strength as a function of institutional buying or selling, a function of institutional preference over other stocks. And as they prefer this particular stock, then it should be reflected in the way how the price behaves and how the volume behaves. Okay, well, let's look at 2008, 2009. At point number 1. Okay, let's start with point number 2, will be easier. At point number 2, what is stronger, what is weaker?
Home Depot is stronger at point number 2.
Okay, look at this slope, right? Previous significant high.
Yep.
What does the market do at this high? The market is trying to go up and it fails. So the market is weaker, the stock is stronger. Point number 3.
So from 2 to, well, I'll say,
From significant
from
low
1
to significant low.
Yeah, definitely. I mean, just looking at your, okay, I'm going to cheat. I know I'm looking at your low on SPY, and I'm just trying to draw the line there and the line there. But Home Depot, it does, I mean, the relative strength chart's actually going up. I can't really tell, Roman, just to be honest with you, without drawing the lines. But looking at the
No,
RS
but
chart, I mean,
I want to hear how are you drawing the lines in your mind. So
yeah,
for point
so
number 3, what is the what are you comparing point number 3 to?
from 1 to 3,
Okay,
from point
so
number 1.
that's
Yep,
correct. So we're taking
yep,
1 and 3. We're
yep,
connecting these two lows. Here's
yep,
our slope. We are synchronizing the low
yep,
market,
yep, yep.
and we're basically doing the same. So I would say that maybe visually it's going to be hard here to compare like this. Again, think about the scales. Those are different. So therefore you have to be cognizant of that. So what do? We look at the relative strength line, right? So here is this flow, and here is the low at point number 3. What do we see here? An upslope or downslope?
See an upslope, so Home Depot stronger.
Home Depot is stronger at point number 3.
Yep.
You also, if you are not using relative strength ratio line, you could do a different trick here. I would always define the support or the resistance at the previous significant point for both the stock and the market. And then I would look at the progression to the downside in this case, right? So the stock has made this progress to the downside. The market has made this progress. So would you say, Adam, that looking at how much deeper, let's say, the market went down, would that define the weakness for you as well?
It would help, but like you said, the scale scales may be off a little bit,
But think
right?
about comparative analysis, right? So we are comparing from one low to another. So we're thinking below the support, how much deeper comparatively the price went down, say for the
Yeah.
market than for the stock.
Yeah, it
And
was
you
it was it was it was more for SPY than for Home
Yeah.
Depot.
And think about, you could think about this also as like number of closes, right? So for instance, the market is at this low when the stock was still somewhere at the higher low at this point relative to point number one, right? So,
Right. Yeah.
the market was touching the support when the stock was still at the lower high. Then as the price starts going below the support for the stock, we see two closes that are below that support, and yet look at how many closes we see here for the market. So this is more sustainable move to the downside for the market. Definitely looks weaker than the stock. So we are seeing a situation where the stock is stronger at 2, stronger at 3. What about 4?
Um, so from 2 to 4, and that's another really tough line to draw there.
Mm-hmm. And
I mean,
think about maybe like again line here at support line at 1. What do we do relative to that line?
yeah, well, Home Depot is, I mean, better. It's higher. Yeah,
So looks stronger to us.
yeah, looks
We
strong.
could compare it to point number 2, which will actually, I think it will be actually lower, right? So
Yeah,
there, okay.
yeah, looks like a downslope. Yep.
Yeah, looks like a downslope. So we would be thinking, okay, relative strength, is showing us that the stock is at point number 4, maybe not recovering as much, but it would be really hard to see right here. Okay, point number 5.
Let's see. So from 3 to 5, and then yeah. So SPY looks pretty flat. Yeah, or higher. Yeah. So SPY looks stronger for sure.
Flat, flat,
Yep.
and
hmm
then slightly higher low
hmm
at 5.
Oh, also Home Depot, of course, is stronger. Yeah.
Stronger, 6,
Yeah. Yep. Same thing.
6. Look at how 4 and 6 in the market, lower high, higher
hmm
high. So definitely stronger. 7,
Yeah. It's Home Depot looks stronger. Yep.
stronger.
Flat.
8,
Same thing. Sloping up, and the other one's sloping down. Yep.
9,
Yeah. It's sloping down, and that was pretty. Yeah. So Home Depot's stronger. Yeah.
10,
Stronger. SPY still looks pretty flat there.
and
Yeah.
then 11.
Yeah, that one,
Harder to see. So
yeah, really hard to see. Yeah, so you'd have
use
to,
the relative strength and then
yeah.
look at 11.
Wow, pretty similar.
Yeah,
Looks
so
like a dead heat. Yeah, looks like a dead heat there.
yeah, maybe slightly either the same or
Yeah.
slightly weaker or something like this. So now
Yeah.
look at the different picture here. What are we seeing here? Strength, 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 and then some temporary weakness. What does this comparative strength and relative strength as well? Look at the uptrend of the
Yeah.
relative strength while the stock is actually consolidating. So what does it tell us? That all of this strength? Adam,
Well,
what do you think?
that we're probably gonna, the causality is showing us that the effect is going to be long-term uptrend or outperformance compared to SPY for Home Depot.
Okay, so in terms of the performance, we're seeing that there are so many points of institutional buying that is being converted into the picture for us of how the price uh, holds up much better in the downtrend of the market and during the trading range of the market. So this means that institutions are buyers. Therefore, this is an accumulation. and they are buying throughout this whole structure. So there is a long-term outperformance as a function of a fact that might come in place. This means that this is going to be a preferred theme for institutions. Therefore, if this is a preferred theme, they're going to stay in the trend. This trend is going to be sustainable on multiple levels, sustainable in terms of the business cycle type of move. It also could be sustainable in terms of even if short term the revenue expectations become negative, sustainability of the long-term picture just because CO is present in the stock might be very significant. The CO might support the stock on the short-term negative announcements. And we've seen this so many times. So CO supports short-term weakness. What else is here? It could outperform on absolute and relative basis. So all of those things could happen just because institutions are eager to get into this position. And we see that from the relationship of prices between the stock and the market proxy. We're seeing their urgency to be in this position long term. And this is so different than the previous trading range that we've looked at. Right? Let's look at that again. In this area right here, everything was weak. In this area right here, everything is strong. So let's see what happens next. I just want you to establish this in your minds, this whole causality. So in 2002, 2003, where we said that the long-term picture was underperforming, suggested long-term underperformance. Okay, well, we know what the market has done here, right? And we know what the stock has done here. Actually, probably would be even better to see on a different chart. Let me just go to this chart right here. So we said in 2002, 2003, long-term underperformance and short-term outperformance. Short-term, we outperformed here, and then long-term, we went into a trading range, whereas the market was doing what? The market was still going up. So this is a long-term underperformance with the short-term very quick outperformance. So therefore, no long-term investment trade at this point, and only short-term swing trade. Now look at 2008, 2009. This is a different picture. We looked at this whole trading range and we said this is the trading range that outperforms on so many levels. Short-term, long-term, everything is there. They want to be in this position. So this strength is causal and is going to bring a specific effect of outperformance. And we said that the institutions want to be in this theme and they're not going to provide a lot of supply. And look at the sustainability of the trend. Look at the business cycle type of trend lasting for so long. And look also at the timing. it's either absorption through the trading range, absorption through trading range, that is going to show us relative strength outperformance, or maybe very aggressive buying, like for instance in phase D on a sign of strength where we see urgent demand and urgent absorption. In this two different ways of how institutions get into this position, either slowly throughout this whole trading range or maybe very quickly, just because there is urgency to be in that stock. And we didn't see that urgency or buying throughout the trading range in 2002, 2003, and we saw it very clearly in 2008, 2009. 2008, 2009 suggested the timing is now for a much more significant trade uptrend. Look at 2002. There was no long-term indication that this is going to be a big campaign, and it wasn't. So therefore, as price, relative performance is causal, and we could measure the effect of that causality. Let's look at this picture again. Adam, give me really quickly some kind of label in here of this trading range.
Let's see. So I guess number one would be potentially you're selling Climax. I don't know. Maybe, yeah, it looks like a selling Climax.
Probably.
Or maybe
Looking at three. Look at this climactic run. This is going to be your lowest point.
Okay.
Here. So 3. Let's start with 3 as the climactic action.
And so your
4.
AR, your automatic reaction.
5.
Secondary test. There's your phase A.
Phase A. Okay.
Yeah.
Test and B.
Test. Yep.
7.
Up thrust.
8. Okay. Yep. Up thrust.
Yep.
Secondary test. What about 9?
9, I guess that's your third secondary test. So that could be your phase C at 9.
Second point of fear. Look at how the price goes down. Look at how the price was going down into point number 3. So the same magnitude reactions. Second point of fear. Phase C. So therefore everything in between A and C is B. So therefore 10 is
D.
The phase
so that's
D.
Your major sign of strength.
And then 11.
Backing up your it's your backing up action.
Yeah, backing up trading range right here, just more complex here. And that's the whole structure. So here is your phase D. So as we are showing a lot of our points of outperformance at 2, at 3, at 5, at 4, at 6, at 7, at 8, at 9, and 10, think about how the structure is being created. So the stock goes down from 2 to 3. Institutions are seeing a lot of liquidity. They love this theme. They think that this is going to be an outperformer for the future. They are buying the selling Climax. They are stepping in because there is no fear there. That's their system. That's how they accumulate the stock. They accumulate the stock based on the value. The valuation, the future valuation of this company for them is somewhere much, much higher at the end of the business cycle. So they would be willing to buy on liquidity of this climactic run to the downside. And that's how the price is being stopped, because they provide so much demand and absorb the supply. At some point, the sellers are just gone and they just exhausted and they stop selling. And that's what gives the price initial push into the automatic rally. And then push again off the secondary test. Push again off the secondary test. Push again off the phase C low. And then suddenly, all of the supply that was available between, let's say, 23 and 18 has been absorbed, and whatever is left is not that significant. So for the first time, the sellers will not be able to push the price significantly lower to the support level. And that's how the backing up action is going to be created. And that's also a timing tool for us. All of the phase analysis is just basically a timing tool. It's a timing tool for us that just basically tells us that supply at such levels that we can't even go lower. Expect higher prices and expect some kind of, more or less better move than what you've seen before. So both on the relative comparative and price level, we're seeing such a great example of institutional presence, institutional buying, institutional accumulation, institutional expectations of outperformance for the stock, and also combined together with the market reversal, we are seeing that this could be a significant secular low, this could be a significant cyclical low, and we want to participate in this stock. And usually this type of stock at this point of time is going to be considered for us as a long-term position, a campaign position, where we want to get in and just accumulate on the way up more and more and more. Okay, well, let's see what happens. We are definitely outperforming here on the way to the upside. And then we go into two reactions. 2010, 2011, and then 2012, 13, I believe. So we'll look into this. So let's look at the first one, and let's go a little bit faster. Adam, let's look at just the relative strength. What do you see into the top of the price action? And this is the price action that came after the trading range that we just looked at. So there is a lot of outperformance on the way up. We see that in the relative strength. And then what happens next?
It just falls apart. I mean, it breaks down.
And
Home
what does
Depot.
this suggest on the institutional side?
There's institutional selling taking place.
Yeah, something is going on, specifically here.
Yeah.
We're seeing how both the price goes below the previous lows, and the relative strength line also just suggests such a drop in the leadership, in the short-term leadership. Well, please bear in mind that this is short-term, right? So this is not long-term yet.
Mm-hmm.
So this underperformance is very short-term. We need to see if there's going to be some kind of buying after that. But look also at the market. This was a flash crash
Mm-hmm.
on May 6th, and then the market is flat. The stock is actually going down, so there is weakness here. And this weakness, even though it's a short term, it just basically suggests a pause. Because if we think about the long-term picture on the leadership, we said that we're going to see a long-term outperformance. But during this long-term outperformance, it's still going to look as if the price moves in the uptrend. It's going to have a move up. It's going to have a short-term weakness, short-term deterioration. A move up, short-term weakness, short-term deterioration. Move up, and then it's going to have a much more substantial deterioration that would suggest a more substantial pause in the long-term uptrend of the performance. So therefore, when we see these spots, we need to figure out how institutions are coming into this position. Are they aggressive? Are they not aggressive? If they're coming in right now, does it mean that the big move is going to happen now, right afterwards? So Adam, looking at what happens next in this formation right here, what could we say?
They're coming back in and holding the price at what 28 there, but it doesn't look like they're coming in big. I mean, you don't see a huge move up. I mean, it's
Uh-huh. So
see
something like this, right? On the relative strength, on the comparative analysis,
mm-hmm.
we could see how the price of the stock moves and then how the price of the market moves.
Mm-hmm.
We could see that the stock is short-term more aggressive, so more buying, and this more buying short-term suggests short-term outperformance.
Right.
And where is that short-term outperformance? Well, in two places. We see a short-term outperformance here, and then we see a short-term outperformance right here.
Yeah.
So it reminds me a little bit of what we have seen in 2002, 2003. The long-term picture was somewhat weaker and suggested that institutions are not seeing this current reaction as the reaction from which the price is going to significantly go up. I mean, it still goes up, by 50% or so. But then it fails and it goes into the consolidation. It actually comes back to this level and retests this low. So think about this. If we would be seeing short-term outperformance and we would be mistaking this for a long-term outperformance, we could come in into this position, and then when the price comes back into this area, that would be a big question for us. Because the price is already at this level, there is a lot of inefficiency over us going to 39 and then dropping and then holding on to the stock. So the timing is important here, and sometimes the timing is going to be defined by us by looking at how institutions behave. And from the relative strength and comparative strength analysis, we don't see that they are extremely aggressive here at this spot. Okay, well, how about the next reaction? So we looked at this reaction right here. How about this reaction, the next one? Would that define the timing like we've seen the timing here in 2002, 2003? It said no, not yet. Then we've seen the timing here 2008, 2009, and it said yes. Next reaction right here, not yet. Let's see if here we're gonna see the timing for us to come in into this position. Okay, well, Adam, it's all yours. So at point number, let's say at point number one, are
Yeah,
we
it's all
stronger or are we weaker for the stock?
we are stronger.
Okay, so what do? By comparing it like this, defining the low. Okay, let's see, this and this.
Ah, I
So, but
guess.
there is, okay, so I'm gonna
This is
talk about this in discrepancy, and there was a question here, I think it was from Nilesh. Are there any discrepancies between, let's say, the relative strength line and the comparative analysis? There could be one. The thing is, when we are comparing the low to the low, we cannot take the data point of the close, and this is what it is. This is the relative strength line based on the close. What we should do when we compare the low to the low is to compare the actual data for the low to the actual data of the low as well. So, for instance, the close here is at this level on this bar, but the low of that bar is here. So you could see how different the measurement could be. And I want to make this note for you because this is going to be important for those of you who's going to actually codify this. And we've had a student, Howard, who actually not just codified this, but he created an indicator that was available on TradeStation. And you still can go to our website, and under the tools, you could find his work. And actually today I'm going to show you some other things that he did for us. Okay, well, let's say that maybe at 1 we are somewhat weaker than the market. Okay, then what about 2?
So previous high to 2. I mean, that's definitely less steep. So Home Depot definitely looks stronger.
3,
Yeah. Same thing. Home Depot's stronger.
4,
Home Depot's stronger.
5,
Stronger.
6.
Uh, uh, yeah, I don't know. Let's see. At Home Depot looks stronger.
Okay, well, if we are
I
in,
mean,
let's use relative strength. Okay, let's do
yeah,
this.
it's hard to tell on that one.
Okay,
Yeah, just barely. Yeah.
Barely. Yeah, but stronger. Okay,
Yeah,
7.
stronger. Yeah. 7 to 9. Yeah, so going to be stronger, or 5 to 7, excuse me. Let's see, 5. Yeah, you have to draw that one out too. It's hard to tell.
Again, this is just,
Yeah, really tough.
yeah,
Yeah, really.
okay, well, let's just say equal. Okay, 8,
Let's see, 6 to 8, definitely stronger because that one's sloping
9.
down. Oh, definitely stronger. Yeah, market's actually sloping down. Yeah.
And we look at the relative strength line, and from this low to
Yep. Yep.
9, I mean, like, what do you guys see?
That's a
I mean, with,
no-brainer.
yeah, it's an uptrend. So the stock is outperforming in this area everything that the market throws at the stock. And there's just a sustainable short-term uptrend of the relative strength line and sustainable uptrend already of the price. We just have not overcome the long-term resistance. So the biggest question in this area, looking at all of the elements of strength, what does it mean for us in terms of how we look at institutional participation? Are they present? And if they
Yes.
are they buyers or sellers?
Yep.
What do you think, Adam?
They are definitely buyers here.
They're
Yeah.
definitely buyers. And then the next question, are they aggressive buyers or just maybe like usual type of buying activity?
I think they're, I mean, if you, 2011 was one of the most complicated years for the market because of, all the issues with 2011, but they're buying here. I mean, the market was in duress between July and the rest of the year, and Home Depot is going up. I mean, they're buying here. I would say fairly aggressively.
Fairly aggressively.
Yeah.
Why? Because look at the sequence of this strength.
Yeah.
It suggests that they are buying on the rally and they're not selling on the reaction. Buying on the rally again to outperform, not selling on the reaction. Buying more on the rally, not selling on the reaction. Buying more on the rally, not selling on the reaction. This is very aggressive because it's consistent. It's a consistent buying, probably also on the way down in this zone. This is looks like a value zone. So they are aggressive buyers. If they are aggressive buyers, so institutions are aggressive buyers, what does it mean for the supply? Supply, go ahead.
Yeah, just saying, yeah, it's being absorbed. I mean, supply is moving into institutional hands, and prices are going to ultimately keep going up pretty nicely.
Yeah, if supply is absorbed, remember, guys, that story
Yeah.
about the ice cream? The more we sell, the more supply goes away from us, and the more that supply lands into the hands of the CO, of the composite man. Now, the composite man is not interested in selling this supply in a month or two, or even a year if the prospect is really good. They're going to hold on to that supply, not present it to the markets, and then as the price starts to perform better, that's going to attract other institutions. Those are institutional trend followers, and they're going to say, well, this stock performs so well, let me get more stocks. But there is not a lot of availability of the supply at this point of time. So they will have to auction for to get the shares of the stock, and they're going to go into the auction scenarios where they will buy the stock at the higher price, like it's shown here. This is all buying on the way up. It's more subtle because the volume signature is going to be less. Majority of the institutions would prefer to get in on the liquidity, but this defines a lot of the institutional presence. They are buying, and they're consistent and aggressive buying, which, by the way, Adam, should lead to what kind of long-term effect? Would the stock outperform long-term?
Yes, absolutely.
Yeah. So
Yeah.
long-term outperformance, that's what we should
Yeah.
be expecting. So with
Yeah.
this long-term outperformance, we would be thinking investing, long-term position. We could still do a swing. We could
Mhm.
do a swing trade because Short term also defines outperformance, so we should be in the stock in a swing as well. And look at the relative strength trend. I mean, this is probably one of the most persistent relative strength trends that I've seen. It just goes up and up and up. It doesn't go into extreme overbought or extreme oversold. It's just very sustainable. The reactions are really small. All right, Adam, thank you.
Yes, you bet. Glad to help.
All right, so let's look at the next trading range here in 2013 and 14. And by the way, yeah, this is the reaction that we were looking at. Right, and we said we've seen the same elements as we've seen on the reaction 2008, 2009. So 2008, 2009 defines more of the long term. 2011, 12 defines more of the timing for the short term cyclical low. And look what happens next. They wanted to be in this position. Why? Well, because it's so valuable to them. They see a lot of future valuation in higher prices, so they want to be in that position before. And look at the run from 30 to 80, more than doubled on that run, and overcame a long-term resistance. And you know, the price requires, or rather the stock requires such behavior by institutions where they're seeing aggressive buying, and that would suggest that if we're going to have the rally, we might actually overcome the high here. So there are a lot of concepts that are tied together here where we look at the relative comparative performance, and we could deduct the way, the character with which the price is going to move. We could deduct the timing of when the price might leave the trading range, and we also could speculate as to the short-term and long-term performance. All right, let's look at 2013-2014 range. And here is the next question. We look at the price of the stock on the daily, and we look at the relative strength ratio line. And this is also based on the daily. We see that the price just basically consolidates. It's a trading range. But then the relative strength is actually going down. So the question that I have for you guys, and I want you to answer this, write it down in your answers, in your questions box, why the relative strength line is trending down. What's happening here? Okay, some answers are coming in. The market is moving higher at the faster pace than Home Depot. Difference between the slopes of the trading ranges, okay, which is basically the same. Slope for the stock, slope for the market. Underperforming the market on the up move. Yes, all of you guys are correct. Look at this, higher highs, higher lows, and even though Home Depot has the same type of structure, higher highs, higher lows, but still Home Depot is predominantly in the trading range. The market is going up in a more sustainable uptrend than the stock. The stock is just consolidating mostly. The market is trending up. So if the market is in the uptrend and the stock is in the trading range, then what is stronger, what is weaker? Obviously, the market is stronger. Therefore, the stock is weaker, and on the relative strength trend is going to be shown as lower highs, lower lows, despite of the prices being in the consolidation for the stock. It's not about the structure of the price that would define for us the relative strength of the stock. It's the structure of the price relative to the of the stock relative to the price structure of the market proxy, in this case, spiders. So when we look at the market and the market is uptrending and the stock is just consolidating, then the stock is weaker, behaving weaker. The price of the stock is behaving weaker than the price of the market. And therefore, relative strength is going to be in the downtrend. But something significant happens later on. We've talked about two ways of how institutions can accumulate. They could accumulate through the trading range, or they could accumulate aggressively on the way out of the trading range. And we're seeing that there is some kind of aggression with which the price moves up out of the consolidation, and how the relative strength breaks the trend and creates a major sign of strength on both. And in a lot of cases, this is going to be a characteristic of phase D. We might have a reaccumulation where the price just spends a lot of time. Institutions are kind of, not interested at this point, and that leads to some kind of short-term capitulations within this structure, where weak hands are giving up their positions, and then suddenly when supply is so low, that's when the price starts to move up, and institutional trend followers are starting to get into this position. And that defines the move of the price, and that also defines the move of the relative strength line. Such aggressive buying, pushing the price higher, suggests urgent accumulation, suggests that they want to be in this position, suggests that we are going to have an uptrend, the timing is now, and this is a potential stock that's going to outperform. And that's exactly how it happened. All right, a homework. A homework is going to be 4 slides. On each slide, you're going to have a market proxy, S&P 500. And I'm going to show you this S&P 500 at an important swing top or bottom. Meaning that if this is the top, then the next move is going to be to the downside. If this is the bottom, then the next move is going to be to the upside. So I'm effectively giving you a bias definition for the next swing. Your task is to look at the stock or stocks and choose at the market top the stocks that are in the distributional or redistributional structure, that are in phases C, D, O, E, and that have comparative advantage over other stocks to be a leader on the way down. At the market bottom, you just basically doing the opposite. You want to define the stocks that are going to be in the accumulation or reaccumulation range, that will be in phases C, D, O, E, and that and their comparative analysis suggests that they're going to outperform the next move up when the market resumes its swing. That's the whole task. Let's look at this. All right, so here are 4 stocks, or the 4 charts. Here is an S&P 500. This is, I believe, 2011. You don't, you can have this information, but it's not really that necessary. I'm showing you that this is the market top, and that the next swing is going to be to the downside. So if the price is going to go down, the question that we have is stock number 1 going to be the best stock to pick for a swing to the downside? Or is it going to be stock number 2? Or is it going to be stock number 3? Or maybe all of them? You will have to show me. You will have to conduct structural and comparative analysis. Combine them together and make your selection as to the stock or maybe multiple stocks. Any questions on the homework? And you have 4 slides here. So in this case, the next bias is to the upside. We know that the market is going to go up. So which stock out of 3 or maybe multiple stocks that you will be buying, that you will be selecting as your buy? Okay, next one. And one more. All right, well, let's see some questions, some comments. Okay, a question from Nilesh. Is comparative analysis useful to identify distribution of leading stocks with upsloping trading range? Okay, so let me just go somewhere else. We're looking at this scenario. Let's say this is a leadership stock, and we have higher highs, higher lows. How would the relative strength behave? It just depends on what the market is doing. So I can't really answer this question until we actually see what the market is doing. Let's quickly do that. What if the market is flat? Is the stock stronger or weaker at this point? Yes, the stock is stronger because the stock is making higher highs, higher lows, the market is flat. Okay, how about this? The market is doing this, effectively in the downtrend. Is the stock stronger or weaker? Stronger, absolutely. Okay, how about this? The market is going up in line with the stock, so same structure. The stock is stronger or weaker? Same structure for the market. So stronger or weaker? The same, right? So the stock could behave the same way comparatively as the market. And the relative strength line is just going to be flat, nothing else. And then let's say that the market is just going aggressively up and the stock is going up, but maybe not so aggressively. So the stock is going to be stronger or weaker? Weaker, yes. So here are 4 scenarios that we have to think about before answering the question, whether they're, comparative analysis is going to be useful here defining the distribution, because usually you're going to be having a lot of troubles with the high highs, higher lows in the distribution. It's going to look like a reaccumulation. This most recent drive to the downside into the December lows, such a great example of that, where we could have stocks like Navadia, leadership stocks, having this pattern right here of higher highs, higher lows, and then suddenly on the sign of weakness, an LPSY, they lose all of the leadership characteristics and then they become weaker. So effectively think about what we just did with Home Depot. In some of the cases, we had a weaker long-term picture And then suddenly the stock is starting to behave much better. Strength suggests some buying. And that suggests that there's going to be a short-term outperformance. Well, the same on the opposite, the mirror side, uh, of the trading range, that's going to be a leadership distributional range with higher highs, higher lows. Once on the sign of weakness, we see a lot of weakness. This is where it suggests that there's going to be a short-term underperformance, where the stock is going to go down much faster than the market. So sometimes I would say that the stock is outperforming on the downside. This means that the stock just travels to the downside much faster, and there is more selling for the stock. So it just depends. It really, really depends. It's also contextual as to where we see the signal, where we see that relative underperformance. One of the things that with the relative performance is that when you look at the relative performance, look at the price as well. And both of those have to confirm what's going on. And we'll do an exercise on this where we are taking the relative strength in the price, and then we're confirming the signal of the relative strength with the signal of the price. So we want to see the synchronicity. Okay, next question. Okay. For Forex traders, how can we make relative comparative analysis as you show in this webinar? How can I deduct if some euro pair example, let's say euro against Canadian dollar, is underperforming or outperforming? Okay, well, you guys know that I've traded Forex. So one of the things that I've been using is in Forex, you really have to think about the pairs in terms of correlations. Meaning that a pair like euro dollar, well, actually, let's say euro dollar or pound dollar, most of the time are going to be highly correlated. So from this high correlation, which you could track using some websites, you can go to those and you can find like at this point of time how the two currency pairs are correlated. Is there a high correlation or low correlation? And by the way, there is, a cyclicality in the correlations between the pairs. You have to study that as well. But let's say that we've defined that these two are highly correlated. So what you're gonna do with this analysis is that you're still gonna have two charts, and they're gonna look somewhat the same because those are gonna be highly correlated instruments. But at some point, a stronger pair is to be bought, and then a weaker pair is to be sold. And you could use this strategy in both, let's say, pair trading, or you could do more of the directional trading. What do I mean by that? In the directional trading, let's say that you define the bias as an uptrend. So then your selection is going to be the strongest of the pairs. And you would just disregard the second pair. In the pair trading or spread trading, you could do this. You could literally buy stronger pair, and then you sell weaker pair. And the beauty about this is it makes you somewhat neutral to the directional bias. So in a way, it's almost like you're taking the same asset, because this is a highly correlated asset. You define which asset is stronger. You want to be in that asset, because the idea here is that the stronger asset is going to produce a better effect than the weaker asset. It suggests that institutions are more interested in that pair, so they're going to go for that rather over another pair. So your uptrend in that stronger pair should show you an outperformance. So it could look something like this. A stronger pair might look something like this. And then a weaker pair will look like this. So this spread, initially you're going to take the spread out, right? I probably should have done it like this. Yeah, let's do it like this. So this spread right here is not going to move a lot. But then the spread between these two currencies are going to increase, right? So spread is increasing. And effectively, this is how you're making your money. It's on the increase of this spread where, because of the outperformance of the first currency, there's going to be more interest and more push. And then in the currency that was weaker, there is less interest by institutions to be in the uptrend, so they will be less active, and that's going to create that spread. So it's, you could benefit from the spread, taking away the directional bias, and taking the directional risk away. You could do that. Okay, so that's great. What else? Okay, Philip is asking, so this is how we use the comparative analysis in practice. We identify the probable leader and then wait for phase C or D. Is that the only use? Well, yeah, definitely. We are in the trading range. There is not a lot of use for us right away if we see that there is an outperformance in phase A. Yes, it does suggest that maybe we are in the accumulation, that there is some interest by institutions, and potentially this could be a, an absorption of the supply that we observed in phase A. But we still have to go through phase B and then go into phase C, and we still have to define what kind of relative strength performance we have here. What if in phase A there is a lot of strength and then it just goes away? Again, we don't know. That's why market is so uncertain. We can't really predict what's going to happen next. So we have to always observe and then make a decision. And if we see enough observational points in phases B, C, and D, that would suggest that institutions are present, they are aggressively accumulating, this is the stock that we're going to pick. And obviously phase C and D are crucial to us, so this is where we would be looking at the relative comparative performance. Okay, well, let's look at something different. Let's think of the presence of institutions through the composite Mann accounting. And then we're going to convert that into the concept of a sweet spot on the comparative performance. And again, this is just an attempt for us, to understand what institutions are doing, how they're behaving. So let's go through this. This is a schematic that I've created for you guys with a hypothetical behavioral patterns that I'm showing here through buying and selling of the shares by big institutions. So let's go through this. In the downtrend, on the way down, at the point of the climactic action, the stopping action creates fear in weak hands, so therefore they are dumping their supply. Supply is increasing, but at the same time, because of this liquidity and value, institutional demand increases. And that's what stops the price from moving further down. Institutions are absorbing the supply from weak hands relatively fast, and that stops the price from moving further up. Their subsequent buying pushes the price up, and short professional traders covering their position also producing a lot of buying behind that, and that pushes the price up and creates an automatic rally, which is such a different look from everything what we've seen before. All of the attempts to rally in the downtrend, they look different than an automatic rally, and therefore we call this a change of character. So it's at the selling climax where there is so much liquidity and there is so much value. We, as the CEO, would establish our first position. Imagine that we're CEO. And imagine that CEO needs to accumulate 1 million shares in this particular stock. How would they do this? They can't buy everything right away. They're going to come into the point of the liquidity, establish this position, and then maybe even at the top, they're going to just profit take some of it. And that's going to push the price down, or maybe they are going to be inactive. And with this inactivity, the weak hands would not be able to sustain. They move to the upside, and the price will start deteriorating to the level of the support, where the CEO would buy again, add to the position, just because this is the zone where CEO would be buying. That buying diminishes the supply, suggests a rally. The rally comes to the high, to the resistance. The CEO might take a profit again. And I see this over and over again. I see how, in a lot of cases, the CEO type of institutions, they are willing to take some of the profits because it just stabilizes their equity line, and they are in more favorable situation if the price goes down in the reaction. The next support level, phase C, into the spring, this is where locally supply is going to increase. So CEO is going to step up and buy the last number of shares from weak hands, and that would diminish supply even more. And that would suggest the timing. Supply is in strong hands, or the majority of the supply, or significant supply is in strong hands. And now if the CEO is buying more, then the price is going to start moving up much rapidly, much faster. And at this point, CEO might be buying on the way up, and it can't hide it anymore. So we'll see that first rally as a sign of strength rally, and by the time the CEO is done with this rally, a lot of the positional sizes are quite significant. So we could be at the 800,000 number of shares at this point. So think about availability of the supply. It was just bought throughout the whole trading range structure in the sign of strength rally. Absorbing the sellers that were available throughout this whole structure. So with that, as the absorption of supply and absorption of sellers has happened, what kind of reaction we're going to have here? Well, probably not of the same quality as we had prior in the trading range. We're talking about a smaller reaction that's probably going to come into the area of the support which acted before as the resistance. So for the first time, we're going to have a precedent in the trading range where there is a sequence of buying and selling, a sequence of buying on the rally and the not selling on the subsequent reaction. This sequence we're going to call a sweet spot. Well, what does it tell us? It tells us that as there is interest on the way up by institutions to buy and there is no interest to sell on the way down, the stock is ready right now to start moving to the upside. And this could define the timing for us as to when we should be getting into this position. Let's look at the distribution. And the same behaviors by institutions here. So their goal now is to get rid of 1 million shares. How would they do this? Well, they want to do this on the points of excitement, right? So for instance, into the climactic run, they can sell 500,000 shares, get rid of 1/2 of the position. Maybe they're even selling on the way down. Remember how a lot of the stocks would see a lot of distributional characteristics in phase A, and that would be even a reaccumulation. So we just have to know that at some spots, some institutions will sell, and then we will need to define how aggressive that selling is. Does that change overall bias for us or not? And then in some cases, as they sell, they're going to buy just a small position back just for the prices to stabilize and to push the price closer to the previous resistance. And that action is going to repeat itself until the CO is going to find the opportunity to sell the majority of its supply and maybe even establish some positions to the downside, maybe short selling. So here is how CO gradually gonna distribute the stock. And obviously this is all in theory, this is just how I view this, and this should be a little bit more updated as to how this happens. But I want you to remember a couple of things. CO composite operator, or the composite man, is of large quantity. The size of their portfolio is tremendous. So therefore, they cannot move in and out of the position quickly. They have to spend some time accumulating the stock or distributing the stock. Because of how they do this, the stock might experience some relative or comparative performance issues, like starting to underperform. And if together with the price we see that deterioration on the relative performance, then we could potentially say that we are in the distributional formation. Performance by itself, underperformance by itself, does not suggest the bias. It just suggests that during this period of time there is underperformance. But we could have a reaccumulation and short-term underperformance by price in the reaccumulation, and then still the price would go up. We also could have a situation where, let's say, the distribution is going to have a lot of strength characteristics, and only at the end of the distribution there's going to be some indication that the relative strength has changed. So again, quite a few variations that we probably would need to go through and to discuss. All right. Eric is asking, in the case of futures, for instance, grains versus canola, would we use the same comparative technique as we did with the currencies? Yes. Effectively, we would be looking at highly correlated instruments. For instance, I've used the same technique for gold and silver. You can use the same technique for any other metals. You could use this technique for, I've used it on my intraday level for index trading. When I was trading futures, I would define the bias for the day. I would define the index that would be stronger or weaker, and based on that, I would be directionally selecting a stronger in the uptrend and weaker in the downtrend instrument, and that would bring not just the profitability up, that would diminish my losses. Because think about, let's say, the behavior of two assets. One is stronger and then one is weaker. Let's say if our stop loss was somewhere here. If we are expecting the reaction of, let's say, the same size, let's say maybe like 10%, the second one might actually, just because of underperformance, hit that stop loss, whereas the stronger asset might have a more favorable reaction, and then the resumption of the trend, and the resumption of the trend. So from this perspective, the outperforming asset is going to outperform on the way up and on the way down, and therefore a sweet spot. Outperforming on the way down and underperforming on the way up. And this sequence suggests that there is a lot of selling on the way down and not a lot of buying on the way up. So what's going to happen with this asset at some point when such underperformance is going to be seen by other market participants, they're going to start dumping the stock. And as they dump the stock, they capitulate and they produce a lot of selling of this stock. Selling is going to accelerate the price to the downside, and we're going to see gaps, big spreads, big gaps on news that are going to be favorable or unfavorable. Reaction might be very unfavorable, doesn't matter. So you have to think of relative and comparative strength from an angle of institutional presence and participation. And hopefully this is the main message today that kind of lends into the discussion of what we're doing here. Okay, well, we talked about the sweet spot. Let's talk about the sweet spot a little bit more. So look at this example of Lulu. I'm comparing Lulu to triple Qs, that is the NASDAQ 100 ETF. Look into this area right here, a rally and the reaction. That the reaction is just very small. It's a higher low, whereas the market is making a slope to the downside. So the stock is outperforming on both the rally and the pullback. What can we expect? Somebody's buying on the way up and somebody's not selling on the way down. Who could this be? Institution or institutions. So therefore, with their support, we're probably going to outperform in the next rally. And look at this next rally. We are overcoming the resistance, whereas the market overcame this resistance, but very late. So the stock is definitely performing much, much better. Again, why we're looking at this whole relative comparative analysis? Well, because it suggests that in the future, on the next run, the stock is going to outperform just because we've seen how institutions behaved at this spot. That's the whole key. We are not just want to be right, like being in the market. We want to be in the correct stock that's going to outperform the market. We want to choose something that is going to be more significant in the performance than the market itself. Look at the next sweet spot. Sweet spot. Up, down, up, down, up, down. So quite a different picture here again, where the market is creating short-term weakness and the stock is creating short-term strength, and that again suggests some kind of outperformance. Not a lot this time, but then the next one, look at how significant this discrepancy is between the market and the stock. The market is going down. The stock is trying to be flat and trying to create a definition of the uptrend. So already suggesting that somebody is buying as the market goes down. And we are definitely overcoming the previous high for the stock, whereas for the market, this is just an upthrust. Multiple closes above, but there is really only one close that is significant. Everything else after that is insignificant, even this close here. All right, let's look at the next sweet spot. What if we would look at the big rally and big reaction? Looking at this rally right here, we are seeing that it overcame the previous high, whereas the market actually did not do that. It went into the upthrust situation, but nothing else was there. And then look at the reaction. By the time we are making the low in Qs, we're already trying to get out of this trading range formation. So a lot of strength right here. There is a strength on the rally itself, overcoming the structure, overcoming the resistance for the stock, and then reaction comes to the level of the support, whereas for the market, we definitely see a much more meaningful reaction to the downside. In other words, here we are comparing significant low to another significant low, something that we've done with Adam at the beginning of the session. And then we're looking at the slope, and we see that the stock is so much stronger at this point. And that suggests multiple things. That outperformance suggests a good market long term, because we're looking at the long term sweet spot. So a significant outperformance right here on the way out. And hopefully we have the chart after that. If not, just go check it out. So this idea of the sweet spot was added to the knowledge probably like 7 years ago. And a lot of the students decided that they like this concept and they want to test it. And at the time, I didn't have this opportunity, but then, some of them developed those type of tests, and this is what they've seen. So this is, again, the test from Howard Lask. He is one of our advanced students in our community, and he is the one who has been doing a lot of technical stuff, supporting, all of those tables under the tools. So he decided to do the visual backtesting of the sweet spot concept. And he said, I want to look at the S&P and I want to define all of the moves in the S&P, all of the swings that that had a reversal and are ready to go up. And Howard wanted to identify during the same period of time any type of trades that are going to be in the same direction. And he said, I'm going to use the sweet spot to see if the sweet spot is going to outperform. And as you could see, there is a lot of consistency as to how this type of performance actually suggests that whatever buying the institutions have had on the rally and then on the subsequent reaction, probably the next rally is still going to outperform. And we could see that it's only in 4 cases. This is where the sweet spot has not outperformed. And I think this is a really good result. And statistically, we are outperforming in some cases quite significantly. We have to look at exactly like why, what was in there, and so on and so forth. But still, I would say that we are just trying to get away from the statistical error, but it looks very promising. It looks really good. In a lot of the cases, when we observe a sweet spot, the next rally is going to be an outperforming rally. So in this strategy is something that you could add to your portfolio if you already have like a long-term strategy. And I was thinking about this today. Even though majority of our students are swing traders, I really would like to start developing long-term campaign type of discussions. So we'll talk about this more and more as we progress into the practicum. Coming back to the sweet spot. Again, this idea of the sequence of strength, a strength on the rally and subsequent strength on the reaction. And for the longest time, when I started using this concept for my own trading, it was really hard to follow this sequence. Sometimes the sequence would suggest that, oh yes, there is a lot of rallying, there is a lot of buying on the rally, but then reaction would come and it would be weaker. So it's definitely could be confusing, but at the same time, if we use this as a concept and we have some rules, guidelines around it, I think we could extract a very favorable information as to what we should select and when we should select it, especially for swing trading. All right. Okay, let's talk about filtering. Oh, I misspelled here. We still have about maybe like 15-20 minutes. Let's talk about filtering and scanning tools. Well, here is our case study of Home Depot. This is the last slide. Remember, we had this trading range, and we said that we look at what the price has done. We looked at the relative strength ratio line, what it's done, and we are saying that it's probably a sign of strength in both cases. So we want to establish some other tools that could help us identify a change of behavior. And now think about this. We've talked about the change of behavior, change of character where? In the price structural analysis. Now we're talking about the same change of behavior in the comparative relative analysis. And obviously comparative relative analysis is all about the price behaviors as well. But still, all of those concepts could be applied on for the relative performance. So what other tools would we use? Well, we definitely want to use any type of heat maps. That should help you out as well. We want to look at the peers, meaning we want to look at the group and the peers in the group. So for the Home Depot, this was the home improvement retail group, and you can find that in stock charts. You could find this group in a lot of other softwares. And then for this group, we have two stocks, Home Depot and Lowe's. And let's look at the heat map. So the green is usually going to mean improvement. And here for the groups, we have 156 groups, I believe. So we went from 1 week on June 20th, 2014, from being one of the worst groups in the market, 132 at that point, and then in 1, 2, 3, 4, 5, 6, 7, 8, 9, in 9 weeks, we went to the top 10 group. I want you guys to see this because this is going to be a very important point here that we're making. Look at what has happened during this 9 weeks. The relative strength has improved. The comparative strength has improved. Well, where was it? Well, it was right here, and then the end of this 9 weeks was right here. So what happened was the price. The price went up. It overcame a long-term resistance and committed to the upside. So a significant move to the upside produced a significant rally on the relative strength. We could see that this was the relative strength rise right here. And we could see this in the heat map as well. So heat map is just another tool for us to visualize the same concept. But I want you to think about a heat map from a different perspective. When we look at the heat map, we usually would look at two numbers. We would look at the top performers, and then we would look at the rotation. So usually the top performers would define the stocks in the uptrend. And sometimes, students would complain, well, the stock is already like, with such big relative strength, it usually would mean that the stock is traveling up. It's in the uptrend. But rotation suggests a short-term outperformance. And the short-term outperformance could lead to a longer-term outperformance. And that's what we want to capture, a long-term outperformance. And then comparing it to the structural analysis, we said that this is a sign of strength on the relative strength. So there is some kind of 9-week rotation by institutions into this theme. This rotation defines the timing. This is where the price will start leaving the trading range and start traveling up in a trending manner. And we want to capture that moment because this is going to be the moment when the trend is going to emerge. And we want to jump on that. Okay. Well, let's talk about the relative strength line ratio. How do we create it? This is from stock charts, Apple daily chart. And then at the bottom, under the indicators, you have to put price and then take the symbol of this stock, division column or division sign, and then a market proxy. You could also write something like this. You could write $ symbol, division sign, and then a market proxy. So for instance, I could say S&P 500, SPX. And then all of the charts, whatever symbol I'm going to enter there, automatically is going to create the relative strength ratio price line for that symbol in the S&P. And this is how it's going to look. It's going to look as like this black line You could put this onto the chart, you could put it on the chart, and then in the advanced section, I'm going to put two moving averages, 52.13, and I probably would just change it a little bit here, but the moving average just basically, helps you to define the trend. So look at what happens here with Apple. We're in the distributional formation with the higher highs, higher lows. That was one of the questions about could we define by the relative strength the distribution? Well, look at the relative strength here. It's also in this upsloping structure. It's only when the relative strength started to deteriorate in a more significant way and the price did the same. That's when we could say that from a leadership characteristics, now the price, the behavior of the relative strength in the price suggests that we're going to have lower prices, deterioration of that leadership. And that's what has happened a lot in December with a lot of the outperforming stocks. Like I bring Novadear, we talked a lot about this. So it just the pattern where the leaders are going to be a flight to quality until the last push to the downside, and then they're going to capitulate right there. And then look at how the relative strength and the price confirm each other when the price starts to break out and the relative strength is breaking out as well. Breakout, 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 break to the downside, and the leadership changes as well. So if we would be long-term investors, we would be saying, okay, well, if this is an area of accumulation, I want to see the breakout of the price and the breakout of the relative strength, and follow this pattern until it's broken right here. So this could be our exit. So think about the long-term strategy where we are entering, let's say, at about 65 and we are exiting at about 120, and it takes maybe a year and a half to be in this position, and we are almost times 2 on this position. So we're probably making around 80% annual rate on this position, and we're just using such simple technique, confirmation of the price and the relative strength. And you could read more on this in the chart school. Go to the chart school of stock charts, and start searching, exploring relative strength. And you will see a lot of articles on that would suggest that the confirming signal between the price and the relative strength is an extremely valuable tool for us to define the emergence and the end of the trend. Actually, one of the homeworks is going to be based on this concept, next homework. Okay, now let's talk about our tools on wyckoffanalytics.com. Go into the indicators. I believe those are tools now, so you have to check it out. And use the password Wyckoff123. So obviously do not give it to anyone else. This is just for students. This page was created for our students only, and that was created by our student. I mentioned his name. And when we were looking at what we wanted to create, I said that it would be nice to also have some kind of research page where you could have the stock, like Apple here, see where it is from, which group, which sector, look at the chart, and then look at the group that it belongs to, look at the rotation in this group, and then look at the peers and be able to compare Apple to peers. So for instance, we would be looking at Apple has a rotation from 68 to 41, but then at the same time, Cray has a much larger rotation, where from 91 in 5 weeks, we are getting to point number to the top two in the group. So that is so valuable. What else is valuable is that in this tool you could do this historically. You could go back and try looking at the relative rotation for the whole group or for the whole sector even, and then look at the peers and compare their charts. Because ultimately, when you look at one chart, let's say you look at Apple, before you buy Apple or before you sell Apple, you have to look at other stocks in the same group. You might be missing something. Look at where Apple is. Even though there is a rotation, a really good rotation, but there are multiple stocks above Apple that are much stronger at this point of time. So we would have to think about what to choose from the peers as well. Maybe there are some better candidates that were available at that point of time. So use this page. It's updated each Friday, and please, keep this access confidential. There is another page under the same tools, navigational pattern. It's called the heat map. So we've talked about the heat map. Here we're basically exploring the top-down approach, where we look at the sectors first and we define the leadership in the same way. We define the leadership as the top leadership, so most likely this is going to be already in the uptrend, depending obviously on the market conditions. And then we also want to define the leadership as rotational leadership, coming from, let's say, 8 to 5, 7 to 4 in telecommunication services. So it's when we see this rotation, we're thinking institutions are coming into this space, into this area. So therefore, we need to look at this rally and make an assessment as to are there any candidates that would show the relative strength, show the correct structure, and show us the correct timing. So what we would do, and this is an example of where we would, what would we do here? This was consumer discretionary, right? And then we would look at the consumer discretionary and we would say, oh, okay, under the footwear, we see such a big rotation. Let's look at some of the stocks in the footwear. And looking at the top stock here, Skechers, also there is some very favorable rotation. And then just staying at the top of the leaderboard. So this is a selection process for us, where we identify the market bias first, then we go to the sector level and we say, yeah, I want to look either at the leadership or I want to look at the rotation. And then in that leadership or rotation, I want to find the group that's going to have the same characteristics, either leadership or rotation. Want to look through both of them, and then look at all of the peers, and again, define leadership or define, let's say, a rotation, and look at those charts. That's our process. We are using the concept of the relative strength as a filter mechanism to get to the stocks that are right away showing some presence of institutional activity. And then we start analyzing the structure. And then we start analyzing supply and demand. In a lot of cases, students ask me, well, can I do structural analysis first and then relative strength? You definitely can, but imagine that if you want to look through the whole market, then if you do the structure first, it's going to take you more time. All right, so use this for sure. Okay. Let's stop here. Yeah, 5:30. Let's stop here because I wanted to add something to the selection process. So this is just the intro for us as to how we look at the relative strength, how we look at the comparative strength analysis. This is the intro on the differences. This is the intro on the understanding why this is so important, why we need to understand that the stock is starting to outperform in the trading range and so on and so forth. I'm also showing you different tools, so I want you to get comfortable with those. So go to our website, use the password, play around with the heat map, play around with the research page, then go to stock charts, play around with the relative strength line, create one. I'm showing you how. And then do the homework. Don't forget, you have the homework. Here's the homework. 4 slides. Each slide has a market and 3 stocks. I'm giving you the bias for the next swing. You have to define which stock is not only going to go in the direction of that bias, but it's going to outperform either to the downside or to the upside. Doesn't really matter. We just want to see the outperformance over the market. And then we're going to start the next class with the review of this homework. And it's a lot of fun. This homework is usually a lot of fun for students at this point of time. And then in the next class, we're going to talk about the selection process, and we're going to be a little bit more deliberate as to how we actually get to the stocks that we want to look at. All right, guys. This is it for today, and I'll see you next week. Send me your homeworks. Thank you so much for being here, and have a wonderful week. Thank you, guys. Bye-bye.